Hello out there. This is Ron Schutz again. I'm going to talk today about mostly taxes on investments particularly. And there are other videos that talk about a third form of taxation. So let's just take a minute and refresh here. In the federal side, there's taxes based on income you earn from working. That is usually in the form of a W-2. It could be a K-1 if you're a business owner. Also, investment income, which I'm going to spend some time on today. That usually comes in the form of 1099s. It can also be a K-1 if you're in a partnership. And finally, when you die, Uncle Sam's going to reach into your grave and say, I haven't had enough yet, I want more. Not for everybody. That's going to be for a relatively small percentage. And I have a separate video that I've done earlier that talks about that. But today we're going to primarily talk about the middle area, the 1099 and the K-1 type of income and how that can impact you. So let's begin. Taxes on income and investments. And the big question is, do you anticipate taxes will be higher? The answer is, I believe it will. And one of the things I read in the paper today was that the IRS has been beating down the doors for more revenue to enhance their operation. They claim that for every dollar invested in the IRS staff for enforcement, they collect $3. So Congress appears to be in line with that. In fact, it's been said that they could gain more just by strengthening the IRS than raising the corporate income tax. So let's look quickly at the volatility of taxes. I think this chart does a great job of people visually seeing what the difference is between the highest and lowest rates going back to 1913 when it all started as a temporary tax. And you can see it was in the 90s during World War II. I entered it when it was in the 70s, entered the interest in this. So it really is amazing what's occurred. The average is about 57% if we ran an average across here. So you can see today the highest tax rate is still a little lower than the average. What's going on? There's a current tilt towards greater redistribution, more regulation, more central planning. The government can handle things better than we can. You know, it's interesting, our country became great because people collaborated, came up with ideas, saw problems and solved them. And yet today we seem to be running towards central planning. And that takes away from individual decisions, because if you're sending more money this way, then you have less money this way to deal with it. It is the reality of where we are today. And by the way, our goal in this is to realize that you can either treat the IRS as an enemy or you can treat it as a partner and have it strategically involved in your decisions. We prefer the partnership, strategic involvement approach. So what have the redistributors been doing? All along, they tend to lower the exemptions or deductions, and then they increase the rates. Now, 90% of taxpayers listening to this out there have incomes less than $162,000. That's 90% of the taxpayers. I'm going to talk a little bit about that again. But again, the government is pretty smart. They go where the money is. The top 10% pay over 71% of the taxes. So, going to out to dinner and the top 10% of the people would pay 71% of the tab. That's really what the government has structured. So 1 out of 3 Americans now pay income taxes. 1 out of 3. So next time you're out, we'll look around and realize that if you're paying taxes, you're in a distinct minority. The average taxpayer's tax bill is about $10,500. How much taxes did you pay? You should have completed your tax return about the time that you're seeing this video, or if not, you can go back and look at your last tax bill. It's the total taxes paid or due on your tax return. And if you're more than $10,500, this particularly is for attention of you. So one of the great strategies on investments is called tax loss harvesting. Now, in 2020, which was a great year because we had a great dip and we had a lot of volatility, so it's a great way to look at it. The total return on the S&P 500, and that's before taxes, was 16.26%. That was a kind of an exceptional year. What most people don't realize is that roughly 43%, 108 out of the 252 trading days were losses. That's pretty typical, by the way. And 144 days were gains. So trying to time the market can be very, very dangerous to do. And there was an excellent piece in the Wall Street Journal recently saying Robinhood tax pitfalls. Common tax minimizing strategies are difficult or impossible to implement on trading platforms that have boomed in popularity the past year. And that's because if you're day trading in here or trading very short, it can really impact the tax bill you're paying. And I've got an example of that. So again, tax loss harvesting is one way to potentially reduce your taxes on your investments. And that's just balancing the gains to the losses. That occurs on your Schedule D if you like to dig deeper into this kind of stuff. So what could happen? Here's a hypothetical example. Again, I'm just using the S&P for 2020 as an example. This is for educational purposes only. I'm not suggesting this is a great investment or not a great investment. But you can see 302, roughly 60% of the stocks made profit, 203 or 40 of the stocks lost money. That still contributed to that return. So the idea being, if you invested back here, you sell these at a loss to offset the gains you may have realized in these particular companies in this particular representative year. So again, in up and down markets, like the volatility we saw that I discussed in the last slide, there are ways to achieve tax loss harvesting for those that are aware of that and appropriate. If you're using an index fund or index type of investing, that is not really possible to do. So here's an example of holding period, and again, referring to the Robinhood. You know, in Robinhood, in this case, that they're talking about is the giving to the poor is the government. The government spends more than it takes in, so it's poor, and it's looking for more money. This is a hypothetical $1 million portfolio. Again, that's more than some people have, less than others have, but it's a great way to do the economics. For a person, an investor that held their money for 1 year and 1 day, so it was treated as long-term capital gains, and they paid the Obama 3.8% tax rate on their gains in addition to 20% rate. They netted $1,076,200 on that roughly 16% return of the S&P last year. A tax smart that we refer to that as a tax smart investor. Investors that sell right at the year, just 1 day prior to a full year's holding, paid ordinary income tax, which is a rate of 40.8%. That's a 17% differential. That 17% differential is reflected in the amount of money that this individual got to keep versus this individual got to keep. The difference went to the government. So again, how you earn that investment income can have a huge impact on your tax bill. And I've had people come to me and say, I'm paying half my income in taxes. That usually means they're being very tax inefficient on their investments because they don't reach in and ask the investment returns to pay their tax bill. They just write a check out. And when you write the check out, you lose not only the check, but you lose all the opportunity costs on that check that you wrote. So in the next slide, I'm going to show you, we used a composite series of indexes. We taxed it each year, the gains that were realized, and we ended up with this. This is a 40-year time period, and for most people, that's probably going to represent a large part of their investment lifetime of putting money away. We put a hypothetical $100,000 to work, and we left it alone, And the before tax chart shows that we had almost $6.8 million in that portfolio. However, if you recognized and paid the taxes, and again, you're going way back here and looking at it, you lose all that opportunity on that tax bill because it's gone to the IRS. And therefore you lose all this gain that is shown or advertised here. Your after-tax value, 2.6 million. Uncle Sam claimed not only the earnings, not only the tax, but the earnings. So your share, if you had the investment pay the taxes, was 4.1 million less, or 61%. So again, 60% went to the government, 40% you got to keep. And that's something that most people are very much unaware of. And that's why we're offering, and if you got this in an email as details on how to contact us. If you didn't, there is a phone number you can call. But we're offering a series of planning tools if you want to take advantage of it. The most comprehensive is the Tax Smart Planning. I'm going to briefly talk more about that in just a moment. We can also meet with you and go over your tax return line review, or a 2021 tax planning checklist, or to Roth convert or not. And here we do modeling, and we look at whether we can do it in installments or really look at the tax impact over your lifetime particularly. But let's talk about the Tax Smart Planning in more detail. We'll review all your asset allocations, and we'll look at the ones that will be impacted by potentially higher taxes. And I believe taxes are going to be higher. It's not a question of if, it's a question of when. That also leads then to, when should I time my tax deductions? And what about receiving income in 2021? Should I defer it, or should I receive it in 2021? And how about the Roth option if it's available at work in your K plan? Should I or should I not participate in that? And then I spent a lot of time on tax loss harvesting. In this video, we can look at your return and see if there's some things that can be done to help you out in that arena. So I hope you'll take advantage of one of these. We look forward to the opportunity of speaking to you, because each of us needs a custom fit on how to do this. Thank you very much for your time.